Students, welcome to Sunil's tutorial. I'm Sunil Mirwani and today we'll be doing this chapter called as Cost Reconciliation Statement. Let's see question number 9. Working note, let's make working note first, guys. Beginners, P&L, debit, credit, cost sheet. Right, let's start with the sum. They said that the cost account showed a profit of 2,81,750. I'm reading the adjustments people. On scrutiny of their cost and profit and loss account, it was found that the opening and closing stocks. Let's see this. They give you opening stock. Opening stock of raw material as per cost records is 80,000, of work in progress as per cost records is 40,000, and finished goods as per cost records is 60,000. Now the corresponding figures for finance statement are opening stock of raw material as per P&L is 60,000, work in progress is 35,000, and finished goods is 80,000. Right? Next, closing stock. Closing stock of raw material, work in progress, and finished goods. As per cost sheet, is 70,000, 44,000, and 20,000. Right? So remember, closing stock is a credit side entry. So closing stock is going to be 60,000 as per P&L, 60,000, 41,000 and 30,000. Fine. Next, let's move on ahead. They said that they charged administrative expenses 18,000 and selling and distribution expenses 1,27,000. Admin expenses in cost sheet is 18,000 and selling and distribution expenses in cost sheet is 1,27,000. Now, the same figures in P&L, administrative expenses are 25,000 and this is 1,15,000. Right? Now, they have charged depreciation at the rate of 25% on written down value method on its plant, which was purchased on 1st July 2000 for 80,000. Okay, next, depreciation. Now, depreciation as per P&L, in finance account, however, depreciation was charged as per straight line method. Okay, now let's see this. Let's do this working note for working note, that was 1. Let's do another working note for depreciation. Right? They're saying that the plant has been purchased on 1st July 2000. 1st July 2000. I'm going to calculate depreciation as per WDV method and straight line method. Right? The cost of the plant is given to you as 80,000. Right? Year ends on 31st December and this is 2003. So less depreciation at the rate of 20% for 6 months. So this is going to be 8,000
25%
at the rate of 25%. Someone calculate please at the rate of 25% for 6 months. 80,000, 25% for 6 months, 10,000.
Yes, sir.
This is going to be my WDV on 1st Jan 01, right? 70,000 and 70,000. Yes, depreciation at the rate of 25%. On 70,000, someone please calculate 25%. 17,500.
Yes, sir.
And this should be on,
20,000.
since this is straight line method, I'll be calculating 25% on 80,000 only. So 25% on 80,000 is 20,000. This is going to be my WDV on 1st Jan 02. 77. Excuse me?
52,500.
52,500, and this is 50,000, right? Less depreciation at the rate of 25%. So please calculate 52,500 into 25% is
13,125.
13,125, and this will still be 20,000 straight line method. On 80,000 I've calculated 25%, right? This is going to be my WDV on 1st Jan 03. So please subtract this.
39,37,500.
39,37,500, and this is going to be
30,000.
30,000. Okay. Now for the current year. Now our current year is ending on 31st December 2003, right? Less depreciation at the rate of 25%. So please calculate 25% on this.
9,843.
And this will still be 20,000. This is going to be my WDV on 1st Jan 04 or 31st December 2003, right?
29,532.
29,532, and this is going to be 10,000. Okay. Now, that means the depreciation for the current year. Now, in which books they are saying that in finance book depreciation was charged as per straight line method. So in finance book it is going to be 20,000, and in cost records it has been charged as per WDV method, which is going to be 9,843. In the final year depreciation was this 9,843 and this 20,000. Fine, do we get this in clear? Now let's make the cost records. You will say, sir, what about included in factory overheads? I will show you what to do with that, right? Cost reconciliation. Statement as on 1st December 2003. Particulars, rupees, right? Costing profit and less financial profit. Right. Now, they've given you that, guys, the costing profit is 2,81,750. Costing profit is 2,81,750. Give it to you. Financial profit, if you look at your P&L account, financial profit is given to you as 2,70,000. I have both the figures, right? Let's start with the working note. Let's look at opening stock, guys. Opening stock of raw material in cost sheet is 80,000, whereas in P&L it is 60,000. It is more in cost sheet, therefore it will come in more column. More is more. So this is opening stock of raw material. It is more by 20,000. Right? Now, work in progress is 40,000 in cost sheet, 35,000 in P&L. It is more. So work in progress is also more by 5,000. right? Finished goods is 80,000 and 60,000, right? It is 60,000 in cost sheet, it is less in cost sheet, less is less. So opening stock of finished goods will go in less column. $20,000. Next, let's look at closing stock, guys. Closing stock of raw material is 70,000 in cost sheet. It is more in cost sheet, but since it is a credit side entry, it will be reversed. So you will have closing stock of raw material. It is more by 10,000, therefore you will write the amount as 10,000. Reverse because it's a credit side entry. Similarly, work in progress is 44,000 in cost sheet, 41,000 in P&L. It is more in cost sheet. More is less for credit side entries. So for work in progress, 3,000. Right? Now, finished goods is less in cost sheet. It is 20,000 in cost sheet and 30,000 in P&L. So in that case, it is less by 10,000, so it will come in more column. Why more column? Because it's a credit side entry, guys. Finished goods of closing stock of closing stock of finished goods. Amount is 10,000. Next, admin expenses is less in cost sheet. It is 18,000 in the cost sheet. It is 25,000 in P&L. 7,000. Difference is 7,000. So this is going to be admin expenses 7,000. Next, selling expenses is 1,27,000 in cost sheet, 1,15,000 in P&L. It is more, so it is going to go in more column. Selling expenses amount is 12,000. Next, depreciation is 9,843 in cost sheet and 20,000 in P&L. It is less, so it will go in less column. Depreciation amount is 984. No, the difference. Someone please get me the difference.
10157.
10157. Right? Now, what you do, guys, is leave one space and then draw the line. Write this in pencil. Write the figure in pencil because one of the figures is missing. You have to find out that missing figure. Right? The figure that is missing is factory overhead. So we just have to check what is the difference and how do we get this. Someone please add this. You write this first in pencil. Yeah, this. Someone add these four. 20, 30, 40, 42, 47,000.
Yes, sir.
Add this please. 750. 8, 2, 3. 3,28,750.
Yes, sir.
Someone please add this. 20, 30, 40, 47, 50, 50,157.
Yes, sir.
Subtract this, guys. 3,28,750 minus 50,157.
278,593.
278,593, right? You get 2,78,000, whereas you should get 2,70,000 only. When you subtract this, guys, when you subtract 3,28,750 from 50,157, you get 2,78,000.
590.
2,78,593. That, and I should have got only 2,70,000. I'm getting 8,597 extra.
93.
93 extra. Right? To make the cost reconciliation statement tally, I should put the factory overheads in the less column. Since this amount is more, to reduce this, I will put factory overheads here. Right? So this is going to be 8,593. Right? Someone add 8,593 to 50,157.
587,593.
58750. Now if you check your account will tally. 328,750 minus 58750 is 2,70,000. Right? Do you understand? How to get that missing figure? So far they used to give you either the opening stock or the closing stock as missing figure. Here they've given you factory overheads as the missing figure. Right? Let's move on to the next one, guys. Let's start. Now, illustration 10. The company's trading and profit and loss account is as follows. Let's straight go to the adjustments, guys. The costing records show the following balances. Stock, ledger, closing balance. Right? So in that case, they've given you closing stock. Stock, ledger, closing balance is your closing stock. Closing stock as per cost accounts is 89,000. And closing stock as per P&L, look at your P&L account, guys, it's given to you as 80,000. And closing stock is a credit side entry, guys. Next, let's move on ahead. Direct labor. Direct labor. Direct labor as per cost sheets. Cost sheet is given to you as 23,000. And as per P&L, it is 20,000. Look at your P&L, guys, carefully, you will get your direct labor there. That's your direct wages. Direct wages and direct labor is the same thing. Next, factory overheads. Factory overheads as per cost sheet is 13,000. Right? And factory expenses as per P&L is 15,000. Next, administrative overheads and selling expenses are to be calculated at 8% of the selling price. Admin overheads and selling expenses are to be calculated at 8% of the sales. Sales is 1,75,000. Someone please get me that?
14,000.
14,000. So it's going to be 14,000 for both of them. Admin as well as selling. Now, whereas in the P&L, admin expenses are given to you as 10,000 and selling expenses are given to you as 15,000. Right? Now, let's try to see is there any other figure in P&L which would generally not come in my cost sheet, right? Opening stock, purchase, closing stock, direct, factory, admin, no. Okay, that's it. So let's make our cost reconciliation statement. Cost reconciliation statement. On dates are not given to you, particulars, rupees. Let's start costing profit. Had less financial profit. Right? Now, the sum says that financial profit we know is 15,000. From your P&L account, net profit is your financial profit. Right? Okay, now costing profit is not given to you. So let's start with the adjustment. In the cost sheet, closing stock is 89,000 whereas it is 80,000 here. It is more, but it's a credit side entry, therefore it will go in less column. So closing stock is 9,000. Right? Direct labor is 23,000 here, that is in cost sheet, and 20,000 in P&L. It is more in cost sheet. More is more. So direct labor is going to be more. Direct labor is 3,000. Right? Factory overheads is 13,000 and 15,000. 13,000 in the cost sheet, 15,000 in P&L. It is more in, sorry, it is less in cost sheet. It is less, therefore it will go in less column. So this is factory overheads. Less is less, 2,000. It is less by 2,000. Administrative overheads, 14,000 in the cost sheet, 10,000 in P&L. More. Admin expenses, 4,000. Selling expenses, 14,000 in the cost sheet, 15,000 in P&L. It is less. So this will go in less column. Selling expenses, 1,000. Right? This is 7,000.
12,000.
This is 12,000. 15 plus 12, 27,000.
20,000.
Minus 7, 20,000. Fine. Next, let's see the next one, guys. Illustration 11. Working mode. Particulars. P&L. Debit, credit, cost sheet. Okay, let's start. Now, they said that the profit and loss account of Chetan for the year ending 31st December is as under, as compared to cost account. Okay. As compared to cost account, office and indirect expenses are 12% more in financial, whereas selling indirect expenses are 8% less. Let's see this first. They said that as compared to cost account, office indirect expenses. Office expenses. Now they are saying that office expenses are 12% more in financial account. Let's see working note for this, guys. Working note 2. Cost finance. Right? Now let's assume that they have given you they are more in finance. If it is to be recorded as 100, they have recorded 12% more in finance. So in finance, instead of recording 100 rupees, they have recorded 112 rupees. Right? Now we know that office expenses as per finance, that I come to know from the P&L account given to me there. Office expenses as per finance is 39,200. Right? Someone please get me this as per cost. How much is it going to be? 35,000.
Yes, sir.
So now I know that in cost it should be 35,000, whereas in finance it is 39,200. Right? Next, selling expenses are 8% less. Right? This was for office expense. Next, let's see another working note, guys. Working note. Here only. We did for office expenses. Next, let's see for selling expenses. Cost finance. Let's assume that they have said that while selling expenses are 8% less in finance. So if it is 100, instead of 100 they have recorded 8% less, that means they have recorded only 92. Now in finance, selling expenses I know is 23,000. So I should be able to get this. So 23,000 into 100 divided by 92 should give me 25,000. So selling expenses are going to be 25,000 in cost and 23,000 in finance. Right? Next, depreciation on machinery was overestimated by rupees 350. Depreciation on machinery was excess recorded by 350, while depreciation on building was underestimated by 150. It was overestimated by 350 in cost accounts. Because finance account is given to you, it is understood that it is cost account. And I told you when it is overestimated, you record it in the same book. Underestimated, you record it, or under recovered, you record it in the other book. Depreciation on building has been underestimated by 150 in cost, so you record that in P&L. Okay. Now, besides that, let us look at P&L and find out entries that would exclusively come in P&L. Loss on sale of machinery. Loss on sale of machinery is never recorded in cost. So, loss on sale of machinery. Debit side 1250. Depreciation on machinery and building we've already recorded. Debenture discount. Debenture discount. Debenture discount is never recorded in cost. Amount is 400. Next, preliminary expenses. Again, never recorded in cost. Recorded only in finance. 800. How do I know that? Because I know my format of cost sheet very well. Right? Next. Interest on deposit. Interest on deposit. You're going to get this money. It's a credit side entry. Amount is 2,500. Again, never recorded in cost sheet. Then dividend received. Dividend received is 3450. Since it is received, it's going to be a credit side entry. Right? That's it. Now let's see the framework for this. Cost reconciliation statement. As on particulars rupees costing profit and less financial profit.
The financial loss.
Okay, the date is given to you as 31st December 03. Okay. Now there is a financial loss. You write it as negative financial profit. Financial loss is given to you as 1850. It's given in the P&L account on the credit side. You write it as financial profit only, but you write it as a negative figure. Okay. And how do I write negative figure? By drawing your brackets. Okay, let's start with the working note. Office expenses, 35,000 in cost sheet, 39,200 in P&L. It is less. Less is less. So office expense is 4,200. Right? Next, selling expenses, 25,000 in cost sheet, 23,000 in P&L. It is more. More is more. So selling expenses amount is 2,000. Next, depreciation on machinery, 350 in cost sheet, more. Depreciation on machinery, 350 in cost sheet. Depreciation on building is less in cost sheet. So depreciation on building is less in cost sheet. Loss on sale of machinery. Loss on sale of machinery is less in cost sheet. Loss on sale of machinery is less in cost sheet. Amount is 1250. Right? Then debenture discount again is less in cost sheet. Debenture discount. Debenture discount is 400. Right? Preliminary expenses, again less in cost sheet. Prelim expenses, 800. Interest on deposit is less in cost sheet, but since it's a credit side entry, you will have to reverse it. So it's less, but you will record it as more because it's a credit side entry. Interest on deposit. Interest on deposit 2,500. Then similarly, dividend received. Dividend received. 3450. Right? Someone please help me add these figures. 4, 7,
6800.
This is 6800. You will cross check the other figure also.
Yes, sir.
Okay. Someone this is supposed to be added, so subtract this. 6800 minus 1850.
4950.
4950. Right? Add, subtract 4950 minus 8300.
3350.
3350 negative. Right? So my costing profit is 3350 negative. Right? Okay, we'll stop this here for the day. Thank you very much.